Damn!
If you had invested $200 a month since 2010, you would have $84,000 today. Not because you got lucky, because you understood one simple thing about how stock prices really work. The problem? Most people think the stock market is random. They think prices are set by some invisible authority. They think you need a finance degree to understand it. Over the next 15 minutes, I will explain exactly how stock prices are set, so clearly that you will wonder why no one ever broke it down like this before. Welcome to Damn. You have been watching a stock price move, and at some point you wondered, who actually sets that number? Not the company, not the government, just where does it come from? Today we are going to answer exactly that, how stock prices are set. And by the end of this video, you will never look at a price chart the same way again. At the most basic level, a stock price is just the last price two people agreed on. One person wanted to sell, one person wanted to buy. They found a number that worked. That number got recorded, and now every person looking at that stock sees it as the current price. The very next trade might be different. That is why prices change constantly, not because some authority keeps updating them, but because new agreements happen every second of every trading day. I recently started this channel to break down economics in a simple way. We are still at the very beginning, so every subscriber really matters. If this kind of content helps you understand the world better, consider subscribing. It helps me keep going and make even better videos. Thanks. Let us continue. So the real question is, what makes people agree on one price rather than another? That is what the rest of this video is about. Picture a giant digital notebook that sits at the heart of every stock exchange. On one side, everyone who wants to buy a stock writes down the highest price they are willing to pay. On the other side, everyone who wants to sell writes down the lowest price they will accept. This notebook, called the order book, is running live every second the market is open. The moment a buyer's number matches a seller's number, the exchange's system executes the trade automatically. No phone call, no negotiation, just a computer matching two numbers and recording the deal. That matched price becomes the stock's current price. Now here is something most beginners get wrong. The price you see on your phone or brokerage app is not a live quote for what you will pay. It is the record of the last deal that already closed. If you place a buy order right now, you might get a slightly different price, because by the time your order hits, newer deals may have already shifted things. The gap between the highest price a buyer will pay and the lowest price a seller will accept has a name: the bid-ask spread. It is usually tiny for popular stocks, sometimes just a cent or two. For less traded stocks, it can be much wider, and that gap costs you money every time you trade. The reason a stock price goes up in any given moment is simple. Buyers are getting aggressive. They stop waiting for sellers to lower their price and start paying whatever the sellers are asking. That demand sweeps through the sell side of the order book, and the price climbs. When sellers panic and slash their asking price to move shares fast, the buy side gets drained and the price falls. There is no mystery to it, just supply and demand playing out in real time, thousands of times per minute. The order book tells you how prices move second by second, but it does not tell you where they should be. For that, you need to think about what the company is actually worth. Say someone offers to sell you a small business that earns $100,000 reliably every single year. How much would you pay for it? Probably more than $100,000, maybe 10 times that. You are paying today for all those future years of profit. You are buying a stream of earnings that has not happened yet. A share of stock is the same thing on a smaller scale. When you buy one share of a company, you own a tiny claim on everything that company will earn in the future. So smart investors try to figure out what all those future earnings are worth right now, in today's money, and compare that number to the current stock price. If the stock trades below what they calculate, they buy. If it trades well above, they hold off. The formal process for this is called discounted cash flow analysis. Do not worry about the name. The idea behind it is just this. $1 you expect to receive 3 years from now is worth less than $1 you have in your hand today. Inflation eats at it. Things might go wrong. You could have used that dollar for something else in the meantime. So you apply a discount to shrink those future earnings down to their present-day value. Add them all up, divide by the number of shares, and you get an estimate of what the stock should be worth. If the stock is trading at $8 but your math says it is worth $12, That looks like a bargain. If it is trading at $20 when your math says 12, it looks expensive. Warren Buffett built most of his reputation on this kind of thinking, buying companies at a price well below what he calculated they were worth, then holding until the market caught up. There is one more force shaping stock prices that most beginners never hear about until they lose money: interest rates. When central banks like the Federal Reserve raise interest rates, they are raising the cost of borrowing money across the whole economy. That sounds like a banking problem, not a stock market problem. But it hits stock prices hard because of something we just talked about: the discount applied to future earnings. Higher interest rates mean a higher discount rate in that valuation calculation. A higher discount means future earnings shrink to a smaller present-day value. The same company, earning the same profits, is suddenly worth less on paper purely because the math of discounting shifted. Nothing about the business changed. The interest rate changed. This is why growth companies, the ones whose value is mostly based on profits they expect to earn years from now, rather than right now, get hit the hardest when rates rise. Their earnings are further out in time, so the compounding discount does more damage. A rate hike can send a high-growth stock down 30 or 40%, even when the company has not missed a single earnings target. Rate cuts reverse this. When borrowing gets cheaper, the discount shrinks, future earnings become more valuable in today's terms, and stock prices across the board tend to rise. This is one of the main reasons markets celebrate when the Fed cuts rates. Mechanics explain the moment-to-moment movement. Valuation explains the long-term direction. But human emotion? That is what causes the explosions in between. Researchers who studied professional securities traders during live market sessions found measurable physical stress responses: elevated heart rate, changes in skin conductance during volatile trading periods. These were trained professionals whose job it is to stay rational. They could not always do it. The emotional pull of watching your money move in real time is powerful enough to override logic even in the people best trained to resist it. The two emotions that move markets are fear and greed. When greed dominates, investors assume prices will keep climbing. They buy at peaks, ignore warning signs, and pile into whatever worked last week. When fear takes over, they sell everything, including perfectly solid companies, just to feel safe. Neither of those decisions is driven by math. One pattern is particularly costly. People feel the pain of a financial loss about twice as intensely as the pleasure of an equivalent gain. A $500 loss hurts more than a $500 win feels good. This makes investors hold losing stocks far too long, waiting for a recovery that may never come, while selling winning stocks too early to lock in a small profit before it disappears. When millions of people make the same emotional error at the same time, you get bubbles and crashes. Prices that shoot far above what any honest valuation could justify, then collapse hard when reality reasserts itself. The clearest modern example of all three forces colliding at once is GameStop in January 2021. GameStop was a struggling physical video game retailer at a time when gaming had gone almost entirely digital. Large hedge funds had borrowed and sold massive amounts of GameStop shares, betting the stock would fall further, a strategy called short selling. The short positions had grown so large that they exceeded 100% of the shares actually available to trade, which is technically referred to as naked shorting. A group of retail investors on the Reddit forum Wall Street Bets identified this structural exposure. They coordinated a mass buying campaign. As their orders hit the buy side of the order book, the price started climbing. As the price climbed, the hedge funds that had bet on a falling price were facing mounting losses. To close their positions and stop the bleeding, they were mechanically forced to buy shares at whatever price the market demanded. That feeding loop sent GameStop's stock up roughly 1,500% over 2 weeks. Not because the business suddenly became valuable, not because earnings improved, because the mechanics of the order book, amplified by emotional crowd behavior, created a trap that forced institutional selling to reverse into institutional buying. Fundamental value became completely irrelevant for a short but violent period. It was a case study in how all three layers of the market, mechanics, valuation, and psychology can operate independently of each other, and what happens when emotion gets a structural advantage. Gravitational pull that prices tend to move toward over time. And the emotional state of millions of market participants, their fear, greed, and cognitive blind spots, determines how far and how fast prices deviate from that gravitational pull. Most of the time, these three forces balance each other out. But when one overwhelms the others, that is when you get the events that make headlines: crashes, bubbles, short squeezes, and record-breaking single-day swings. If this breakdown helped you see how markets actually work, subscribe. Why cover financial concepts exactly like this every week? Drop a comment with the topic you want next. We read them all. Investors who do well over the long run are not the ones who predict every move. They are the ones who understand which force is driving prices in any given moment. They read the mechanics without panicking over short-term noise. They do the math on value without pretending the emotional reality of the market does not exist. And they know their own psychological wiring well enough to avoid making the worst decisions at the worst times.